Hello and good morning, everyone, and welcome to the latest in the Novia Global Pulse webinar series. Delighted that we have with us this morning Nathan Sweeney from Marlborough for the first in our sessions after the summer. So I hope everyone had a great summer. And obviously, we're seeing a lot of headlines at the moment, which clients are being bombarded with news around inflation figures, interest rates, cost of living crisis. So I'm sure you're having a lot of conversations with your clients regarding sticking to long-term business plans that you've put together for their financial planning. So this morning, Nathan's going to talk around the current economic climate and also talking around the opportunity that naturally will start to present themselves. As always, there is the opportunity to ask any questions or queries along the way. There is a bubble at the bottom of the screen. So if you want to press on there, I'll collate those during the session and we'll cover those off at the end. Looking about 35 minutes for Nathan's session today, and then obviously time afterwards for questions. So without further ado, I'll hand you over now to Nathan. Thank you.
Sorry, just finding the unmute button. So thank you, Paul, for the introduction. Good morning, everybody. Thank you for taking the time to join us today. So the title of today's presentation is Stay Invested, Time the Market, or Hold Cash. So what I wanted to do was try to investigate the mindset of today's investors, and with that, provide a view and an outlook on cash, bonds, and equities. So I promise it's going to be an engaging and insightful presentation. And obviously, if you do have any questions, as Paul mentioned, just drop them in the box and we'll pick them up at the end of this presentation. So let's click through. So the first thing I wanted to talk about was just a little bit on Marlborough itself. So what I wanted to get across here was that, we are quite a well-known company within the UK asset management space. But for me, one of the key attributes for Marlborough is the fact that it's a privately owned business. So I believe that that's a good thing because it gives us a very long-term view. And it means that we're not necessarily distracted like some of the other big companies in the space by something like your share price or short-term revenue targets. So I think that that's something which is unique to Marlborough relative to a listed company. And I think that's quite important because it ensures that the investment team are focused on managing clients' money, which is clearly what we should be doing. Now, I'll just move on to the next slide. Just in terms of team, I think we're really privileged to have quite an experienced team at Marlborough. So as you can see on the slide, there's lots of people responsible for managing your money. We've got a number of portfolio managers within the team, and recently we have actually promoted two of our assistant portfolio managers. So you'll see Scott Truter and Sarah Tardino have been basically promoted to help support myself and Raj in managing your portfolios. But actually, I'm just going to move on to the main topic of today. So let's look at the agenda that we've put in place. So, the question we're really trying to answer here is about the market environment today. I think, the question is it an environment that you would consider challenging from an investment perspective? And the way I wanted to address that was by talking about the cycle of investors' emotions, because I think it's quite important to remember that investing should be something which is logical and rational. But the reality is that investing can be driven by emotions. So I'm going to talk a little bit about that. I think as investors today, you're probably concerned about the fact that maybe the bond side of your portfolio hasn't done as well. So we know that last year was terrible. Equities are doing a lot better this year, but the bonds aren't participating as much. They performed positively, but the performance hasn't been great. So that hasn't really contributed enough to those 60-40 type portfolios. So I'm going to give a little bit of insight into the bond side, what's happening there, what we expect to happen going forward. I think critically, a lot of people are considering, should I be investing in cash today? So I want to talk about that. So what are the merits of staying invested or timing the market or holding cash? And then I think importantly, given the fact that there's a lot happening in markets today, you'll want to know, what's next for markets. So I'll provide a little bit of insight into where I think we're moving next in markets. So I'll start with the cycle of investors' emotions. Now, I found it very interesting when I read this statistic, and I actually turned it into a chart of the week. So ultimately, the statistic shows you that 90% of investment decisions are driven by emotions rather than logic or reasoning. So that's quite a lot of emotion going into investment decisions. So this was a survey that was carried out by MoneyWeb. It was carried out in 2022. I think it was back in October 2022. And I suppose the reality is that money is personal. So it is emotional, because if you've saved up your hard-earned cash and you're looking to achieve a financial goal, whether that's your retirement or saving for a house or education for your children, if you see that money fluctuate in the market, it's going to cause an emotional reaction. What this chart shows you is that those emotions change with the investment cycle. So you can see that if I was to take a look at cash or equities or bonds and say, where do you think they fit on this chart? You would probably put them in different places, which I find interesting. So you might think, actually, from a cash perspective, I'm feeling quite optimistic. Or maybe you're feeling a bit stronger about that today. From a equity perspective, you're probably feeling, actually, I'm feeling a bit more relieved compared to last year, whereas feeling a bit hopeless about the performance of equities. Whereas bonds, you're probably feeling a little bit hopeless about the performance of your bonds. So you can see that we basically feel emotionally about investments in different ways at different points in the cycle, and asset classes you can feel differently at different times. So if we go a little bit deeper on this, there's actually a number of behavioral biases which are well known. So you've got examples like overconfidence bias, herding, anchoring, and confirmation bias. Just to give you an example, so herding is ultimately everybody doing the same thing at the same time. So essentially everybody buying at the same time, everybody selling at the same time. And ultimately, sometimes that can be the wrong decision. So you could think about cash today. Is everybody herding into cash? Is that the right decision? Because ultimately, if you think about cash today, it is offering you a higher rate of return. However, it's not offering you a rate of return which is higher than inflation. And so they call this the negative real yield. So yes, cash is yielding you X amount, but when you take away inflation, the actual real yield is negative. So ultimately, is cash the right investment if you are looking to achieve your financial goals over the long term? And I'm going to delve into that question a little bit further in the presentation, because I think that's an important one. So it might look attractive today, but I don't think it's attractive in the long term. Other biases that you might have are overconfidence. So this is really that timing the market piece. So very confident about your ability to get things right and make those judgment calls. And ultimately that can lead to making the wrong decision at the wrong time. So on the previous slide, you'll see that when we're really euphoric about markets, that's when we should be a little bit more risk averse, but that's not likely to be happening. You're probably really overconfident at that point in time and then making the wrong decision. So sometimes that overconfidence can lead you to make the wrong decision at the wrong time. So it is important to stay grounded and rational. And then just on the last two, you've got anchoring. So let's say we had an event that happens. Let's call it last year's performance in the stock market. Stock market sells off. So you're now anchoring to that event. You think that anytime we get a market wobble, it is last year all over again. So there is a danger in that, because ultimately the sell-off that we had last year, as we know, is quite unique. We don't tend to get sell-offs of that magnitude often, and then they don't tend to happen for a longer period of time. But it's still fresh in our mind, and we'll anchor back to that. So there's a danger with that. And then lastly, confirmation bias. So whatever you're thinking, you will seek out information that confirms that. So if you think, actually, I should be in buying a house today, and you read an article and it says now's a great time to buy a house, you say, okay, I want to read that. If there's another article further down in the newspaper that says actually now's a bad time, you won't even read it because you're looking for that confirmation that your view is correct. Now, is that a logical or rational approach? No, because ultimately you should use all the information to make your decisions. Now, all I wanted to do is just give you a little bit of insight into how psychology can affect your emotions, because what you can really see here is that it does impact those decisions. And quite rightly so, because investing and money are emotional. Because of the potential for not achieving those financial goals. And ultimately, it's these biases that prevent you from doing that. And rational investing helps you to do that over time, as in reach those goals. So moving on to the next topic, I wanted to give a bit of insight on the bond market and the direction of bonds from here. So will we be seeing a change in direction? So what I've got in this slide, it just shows you basically different types of government bonds. So we're looking at US government bonds, but those government bonds are issued over different time periods. So we've got a 1 month bond, 3 months, 6 months, 1 year, all the way out to long bonds. Now, this is pre the interest rate rises from last year. And what you can see here is that the level of income you got for that whole range of government bonds was quite low. And that's because interest rates were low. And governments base basically the income or yield or dividend they pay on their bonds off of interest rates. Now, that meant that people had to seek income elsewhere. And you can see at the very end of that chart in the red, you've got the yield, income, dividend on the S&P 500 at 1.79. So basically it's showing you that equities were giving you more income than bonds. And the reality is the US stock market is one of the lowest yielding stock markets globally. So it's quite funny to see that stock market specifically was yielding more than government bonds. So in the financial world, they came up with this term called TINA. Basically, there is no alternative, which just meant that there was no alternative in trying to find yield. So you kind of had to veer towards equities if you were looking for income. But one of the good things to come out of the fact that we've had rising interest rates over the course of last year is now we have lots of income, lots of yield, lots of dividend on these bonds all across the spectrum. So you're getting a nice, healthy income. So now they're calling this TARA. There are reasonable alternatives. I wouldn't call them reasonable. I'd say they're a lot better than that. But it just goes to show you that even though people have been disappointed about performance of bonds, actually now they're offering you a much higher level of income. And I suppose, the question is, why have bonds underperformed, or why haven't they done as well? And ultimately, what you see on this graph here, it's showing you basically a government bonds and the level of income it's paid over time. And this is going back to 1880. So it's a really, really long snapshot of that movement in yields over time. And the reality here, or the idea here, was just to give you an idea of what the normal range looks like. So normally, government bonds tend to give you a income or yield of around 3 to 5%. That's where it sits. So the whole point here is just to help, I suppose, paint a picture that the landscape that we had over the last decade was not normal. So where we had central banks keeping interest rates really low for a long period of time, that was not normal. And what we see today with interest rates moving back up to a higher level, that's actually in that normal range. So we're back to where we should be. So this is just getting back to where we should be. And we think that from here on out, central banks would like to be in a position where they can have interest rates at a higher level. Now, I'm not saying at the level they're at today, but they would like to have rates at 2-3%. Ultimately, that is good for savers, and ultimately it just means it's good for banks because they can generate profit on their loan books as well if you have interest rates at higher levels. But I just thought it was interesting that if you look at it in a historical context, you can see that actually what we've had more recently is not the norm. Now, the big question is, what does that mean for bonds from here? Because we know that when interest rates go up, that's bad for bond markets, and therefore that's the key reason why bonds sold off last year. But what we can see here is that what I've done is I've got the 10-year UK gilts. And ultimately, I'm saying if you had 10-year UK gilts at 6% all the way down to 0%, what would that mean for your return? And that's everything else, all else being equal, what would that mean for your return? So if we look at interest rates today, this is looking at the UK, but you can apply this to any market. If you look at the UK, we've got interest rates are now at around 5%. We've actually got the central bank meeting today in the UK, and they might raise rates again, they may not. So it looks like we're very close to that peak. But what you can see is that if interest rates did continue to go up, bonds will sell off. But we don't think that that is likely to continue to happen. And the reason we don't think that's likely to continue to happen is because now inflation is falling. And inflation continues to come down. And we saw in the UK yesterday, inflation figures came down a little bit more. So that means that it's likely the next move for central banks is to pause, stop raising rates. But once they pause, the next move following that is to move down. Generally, we've looked at historical periods when central banks have paused their rate rising cycle. And generally, within 6 months, they're then cutting interest rates. And because the inflation figures in the UK came down yesterday and inflation figures are coming down everywhere, it means that markets are now expecting actually those rate cuts are likely to come sooner. And what you can see here is that if interest rates did go from, say, 5% to 4%, you can see how that impacts the return on your government bonds. So that 1% movement in interest rates can lead to an 8% movement in return. So it's just a way of helping to explain that if interest rates fall, it will be quite meaningful on the performance of fixed income as we move down towards lower interest rates. So the point here is that, yes, the performance of bonds has been disappointing, but I think for a lot of people, if you link back to that emotional cycle, we're kind of down at this end here. We're not feeling great about bonds, probably a little bit skeptical about bonds and the performance. But I'm feeling a lot more positive because I know that while interest rates have peaked, I'm being paid a lot more income now. I'm less likely to see a sell-off because I know that interest rates have stopped going up and that the next move is likely to be down. So I just think this just helps to paint the picture that actually bonds from this point out look more attractive, essentially. Okay. The other big question I think for people is stay invested, time the market, or hold cash. And so what I wanted to do was we've all seen a lot of various different charts on this, and everybody's produced one. But so I wanted our team to actually look at the data, produce it, and let's do it ourselves because ultimately we want to see how this looks. So what we did is we got 20 years worth of stock market returns, and I've done it for the S&P, I did it for the UK stock market, and I've done it for the Euro stocks as well. So I've got 20 years of performance returns, and we've got the data, and it's quite recent, fresh. So I said, okay, let's just go from here back 20 years. So not gaming it, just picking 20-year period. And what we've done is we've gone up as far as the 7th of the 9th. So the 7th of October, this data is up until. And we said, right, what would your return look like if you stay invested? What would your return look like if you missed the 10 best days every year? If you missed the 20 best days every year, the 30 best days, and then the 50 best days? So interestingly, if you were in the market and you didn't try to time it, This is your average return every year for 20 years. Investing in the European stock market is 8.21%. Now, emotion causes us to make irrational decisions. We might be overconfident in our ability to time the market. So we may say, actually, I'm going to sell out and maybe I'll buy back in when I think it's the right time. And you could do that, but you could miss the 10 best days in the market. And if you did that, your return looks very, very different. So I find it extraordinary that just missing those 10 days, the performance goes from 8.21% a year on average to 1.15%. 1% versus 8%. That's a big difference. And it really highlights, that the importance of staying invested. Because if you try to time the market, you got to get it right. Very difficult to get it right, as we know, because there's usually a lot happening in markets, and trying to interpret what's happening in the market, you really need a team of experts to do that. So I just felt that this was quite compelling, and I wanted to do the research for ourselves so we could actually get the hard data, hard numbers. And what we'll do is we'll just continue to update this every day just to see what that looks like. I'm happy to share it with anybody. Following the call, just give our sales team a shout and we can do that. Now, that's okay because it's just looking at the average return. So I want to know actually what's the impact on money. Give me a real life example. So what I've done here is I said, okay, let's imagine we've got 4 different types of investors. So we've got investor 1 who thinks actually cash is the best option. I'm going to put my money in cash. Then you've got investor number 2. They think, actually, I'm pretty confident in my ability to time the market. And ultimately, instead of getting it right, they get it wrong. So what this investor has is they have £12,000. So I've said I'll come up with a realistic figure. So let's call it £1,000 a month. That's £12,000 a year. So the worst timing ever is they put their £12,000 into the market every year, but they pick the day that the market is at its highest point every year, and they put their money in. But then I've got another investor and they're overconfident, but miraculously they get it right. And they put their £12,000 in the market at the lowest point every year. Genius. They just got a gift from God. But then I've got the third investor and they say, look, I've got no edge. I don't know how to time the market. All I'm going to do is put my £1,000 in every single month. So £12,000 a year, I'm just going to put it in on the first day of every single month. And the cash investor is doing exactly the same thing. Now, what I found fascinating is that clearly it doesn't matter what approach you take to investing, you still beat cash. So there's a lot of talk about cash today, but you can clearly see that if I put all that money in, and I'm putting in my £12,000 every year, and I'm doing that over 20 years, I've put in £250,000 over that period. And if I put it in cash, I'm not really generating the return, which is going to meet my financial needs in the future. That goal I want to achieve, that house I want to buy, the kids' education, it's just not a viable option. But it doesn't matter what approach you take to investing, whether you have the worst timing, the best timing, or you just average in, you beat cash. So I do think it is important to highlight here that even if you had the best timing, the return that you get is not that much different from averaging in. Because how much time and effort, stress, emotional stress, trying to get those calls right, and is it worth that? So I just thought that was also quite an interesting concept. But again, back to the key points, you can see here that investing over the long term to meet your financial goals, it just makes sense. And particularly if you have high inflation, because you want to beat inflation. And over history, we know that investing gives you that optionality, because over the long term, if you invest, that's what happens. And that's why people often talk about the fact that it's time in the market, so staying invested in the market, opposed to timing the market, which matters, because you can see the difference in the performance here from just averaging in versus timing the market. Okay, so I hope that's just giving you a little bit of perspective on cash. And I know that cash levels are more attractive today, but you have to remember that they will not stay at that level, because as the economy recovers and inflation comes down, interest rates will start to fall. So that real euphoric feeling about what cash is paying today will change as those interest rates come down and markets continue to go up, and the differential between the two widens. And this just evidences that. Okay, this is just a little story that I wanted to tell. So I don't know if anybody knows, but I have an allotment. And so an allotment is basically a plot of land that you can get allocated. It's like a communal plot of land. And, so I grow stuff down there. And so that's basically, I live in a place called Kingston in the UK. And so I've got my allotment there. And they've recently brought in a new scheme in the UK called the ULEZ scheme. So it's the ultra low emission zone. And ultimately, that's a scheme whereby if you have a car which is over a certain age, you then have to pay a tax, a daily tax. And that tax is now £12.50 a day. So on the allotment, there's an old guy called Arthur on the allotment. And Arthur is 86. So I got to chatting to Arthur when I was down the allotment, and we were chatting about the ULEZ scheme, new tax coming in. And he was saying, if he wants to drive his car to the allotment, it's going to cost him now £90 a week because he's got an old car. And he was actually talking about, potentially even driving to Spain to go and pick up a car. Like, you can get a cheap one down there relative to the UK. This guy's 86. But, the whole point here is that he's got to change his car. It's a big financial event at his age. It's a stressful event at his age as well. So I felt quite sorry for him. And it really kind of struck me the fact that we are going to live a lot longer than we expect, because we have better healthcare, better eating habits. And ultimately, we need our money to last longer to ensure that we can meet those financial, I suppose, events that happen, which are outside of our thinking. And so this chart I thought was interesting too. This is from JP Morgan. And it just shows you the probability of one person in a couple surviving over the age of 80 or surviving over the age of 90. And they're quite big numbers. And it really highlights that you really do need to save quite a lot for your retirement. And it just reinforces that whole point about investing and investing continually over time, because we know that that is one of the best ways to investing, opposed to timing, etc., or putting your money in cash. Because ultimately, if you retire at 65, and a lot of people want to retire earlier, you could be living a lot longer than you think. So I just found that conversation struck me, and it's got me thinking more about my future and my pension and how I invest. But ultimately, I know that if I just stick with it and keep averaging in, that that's the best approach to take. So I hope, again, that's just giving you a little bit of insight into that question about staying invested, timing the market, investing in cash, how to approach that. And maybe that will help with some of the conversations that you have with clients, because I know this will be a very topical conversation today. But you do have to remember that investing is very much a long-term goal. And you have long-term goals that you need to achieve. And ultimately, we do and will live longer than we expect. So this is quite important too, the what next for markets piece. And ultimately, people will be wondering, where do markets go from here? So the big thing that people were concerned about this year was recession. Are we headed for a recession? And what's happened is that markets have been, I suppose, performed better than people expected, because this recession that everybody was expecting to happen hasn't happened. We subscribe to research from external providers who we believe are really good at what they do. So we get research from the likes of Goldman Sachs, HSBC, JP Morgan, Morgan Stanley. So we pay for this independent research because it helps us to do our job better. And this was an interesting chart that we got from Goldman Sachs, because ultimately what it does is it demonstrates that their expectation of a recession within the US is lower than everybody else thinks. And these guys are pretty good at incorporating the most recent information into their expectations and views. And what we can see here is that they have a really low expectation of a recession happening in the next 12 months. And the reality is they've been pretty much right so far. So we do trust their judgment on that. Obviously, this will change and move as the data comes in. But the key point here is that that lower expectation of a recession has been really good for markets this year because it hasn't happened. If we move on a bit and talk about the reasons why. So why have companies actually performed better than expected? And this is an interesting one here because it shows you how savvy the CFOs, chief financial officers of companies are. So when interest rates were low, pre-COVID, pre all of this inflation, what they were doing was they were locking in debt at really low rates. So if you have a mortgage, you can fix your mortgage for 2 years, 5 years, or 10 years. These guys were thinking, why would I fix for 2 or 5 when rates are so low? I'm fixing for 10. So basically, they were taking on debt at really low levels and fixing that, locking it in for a long period. And it shows you that a lot of companies in the S&P don't have to renew or service their debt for a long period of time. And it's quite a big proportion. And this is one of the reasons why companies' earnings have been more resilient, which is the word which is used a lot, than people expected, because they didn't really have any big debt bills which were maturing. So I think that's quite a powerful slide. And the other thing which is less talked about is we know that central banks are raising interest rates. And to me, the next shift or the next move is really for the baton to pass to governments to stimulate economies. And this is just an example. This is looking at the US, and this is an example of different initiatives that the US government has put in place to drive growth. Because they know actually the central banks is not going to be the key driver of growth from here. It's now our job. So what they're doing is they're putting in all of these initiatives to create jobs to drive growth. And I think if you think about the war in Ukraine, this is a good example of where there's a huge amount of support globally for Ukraine. But ultimately, every single piece of equipment that gets sent to Ukraine has to be replaced. That equipment will be replaced with bigger, better equipment, which costs more. Ultimately, that will have to be manufactured. That creates jobs. So what we can see is that in itself, defense spending globally was about 3.7% of GDP last year. It's likely to increase substantially because everybody will want to spend more on defense because they're heightened sensitivity to the event that's happening between obviously Russia and Ukraine, that war. And therefore, they will spend a lot more on that. There's also a lot happening on, tackling inflation, chip manufacturing, because microchips are in every single tech product. So that's a big area of contention for a lot of countries. And therefore, they all want to spend on that. There's going to be a lot of spending on infrastructure to drive growth. There's going to be a lot of spending on social to drive growth. There's going to be a lot of spending on renewables to drive growth. So all of this isn't really factored in. And that's one of the reasons why markets have also been so resilient. Just on interest rates, I've mentioned the fact that I think interest rates are peaking. When they peak, the next move is down. We know now that that's good for bonds. This is just showing the expectations for rate cuts. This is Goldman Sachs forecast, and they've also got just the market forecast. You actually had the central bank in the US last night said, we're not raising rates. So the rates are on pause. And they said, yes, we expect to cut next year. Cut interest rates. So we're expecting about 2 interest rate cuts next year. Now, if the economy does suffer and you do get a recession, those interest rates come sooner, those cuts. And that then can have an impact on markets. So if we look at markets this year, particularly the US, it's been driven by a small handful of stocks. We all know that. So these 7 companies, the big tech companies, have really driven performance. So if we look at the S&P, let's call it, it's up 17% year to date. 66% of that return is driven by these 7 companies. That's quite a lot. People are concerned about that. But what they're forgetting is, what about the other 493 companies? Because when you get interest rates falling, that reduces financing costs for companies generally. And hey, the profits are going to increase. So you should see broader participation. So that's what we're expecting. So the reason the tech companies started to perform so well was essentially when you invest in tech, it's going to deliver you a performance over a very long time. So when interest rates started to go up last year, these companies sold off because they didn't know how's that going to impact my financing cost to deliver these long-term projects. But once they saw central banks change the rate at which they were increasing interest rates, remember they went from 0.25% to 0.5% to 0.75%, they started to bring it back down. Then the tech companies knew, and they've got a very long-term mindset, actually inflation is under control, interest rates will be coming down. So the share prices went up. You're buying these companies for the long term. So people said, let's buy these first. A lot of these other companies are cyclical and they will wait to get more confirmation that interest rates are coming down before they start to move. And that's what we're starting to see today. So you're starting to see tech actually falter a bit and these other companies starting to move. So our expectation is broader participation. Again, I hope that's given you just a little bit of insight into what we expect to happen in markets. If you want some more detailed information, again, just reach out to any of the sales team and happy to give you a full breakdown of our tactical asset allocation views on what we think in each specific area. So lastly, it would be remiss of me not to show you a performance slide. And what we have here is we've got performance of the different funds within the range that we offer on the offshore side. And this is looking at performance year to date. And you can see, obviously, the Adventurous Fund, which has a higher weighting towards equity, is up 7%. That's a healthy return. And that's because equities are doing better this year. Whereas if you move down the spectrum, those funds which have a higher weighting to fixed income haven't participated as much. We know why, because bonds haven't done as well, because interest rates have been going up, but we expect better performance from here. And again, why would I show you year to date without showing you how we've done since inception? So here's the performance since inception for that fund range. And often a question we get asked is, our performance, I'm told by our sales team, it looks good relative to some of the other providers, whether that's MPS or DFM, and they ask, why is that? So I think relative to MPS, ultimately one of the struggles for an MPS provider is that they tend not to make changes as often. It tends to be quarterly. I think the challenge today is that we are in a very dynamic market where things are changing quite quickly. It's not a low interest rate environment where equities can just continue to go up and thrive on cheap debt. So therefore, you need a more dynamic, active approach to investing. And that's why we've been able to deliver good performance. And we also get the question compared to a DFM. So a discretionary management portfolio, again, why is the performance better than that? And ultimately, this is just my own belief. I find that a lot of DFMs tend to try and overcomplicate the investment piece. So looking at alternatives and, looking at funds which may be a little bit more quirky and have a higher cost, and all of this eats into your performance. And ultimately, a lot of those alternatives haven't really delivered the performance that is expected of them, particularly this year. So if you look at a lot of alternatives, the alternative bucket, a lot of them are negative this year, actually, whereas equities have done quite well. So I think, trying not to be too clever adds a lot of weight. Ultimately, we manage portfolios that we can explain, so you can explain them to your clients. If we're investing in stuff that we don't really understand, how could we expect you to explain it to your clients? It would be doing them a disservice. So I think that's important too. There's a lot in that. I apologize because I know we've only got a short period of time with you today. I hope you found that insightful. I hope that's given you a couple of takeaways for some of those conversations you might be having with clients about how your emotions can impact the way you think about your investments, how ultimately cash can impact your long-term returns, why bonds might be better from here, and what to expect going forward. So I'll just pass back to Paul just to see if we've had any questions come in.
Yeah, thanks for that, Nathan. Some great content there, and as you say, really topical and relevant to some of the conversations that I'm sure our audience are having at the moment with their clients. And quite a good segue then into the first question, because we've been posed a question saying that clients are talking quite a lot these days about AI. Do you see that as an opportunity, or is it in fact just a bubble at the moment?
Yeah, so I definitely see it as an opportunity. So ultimately, AI, artificial intelligence. And what is this really about? It's just about the computers are getting much faster at processing information. So there's a company called NVIDIA, which it's been in the press and the media. I'm sure you've all heard about it. And they make basically computer chips which help with the graphics for the video game display. So it makes those video games look real life. And as they were developing these, they needed to make those computer chips go process information quicker and quicker to make those images more lifelike. But then what other people found was that they've made these chips so quick that we could use them in other computers to do other things, process information quicker. So all of this AI is just about being able to use larger amounts of data and process it quickly. And if we can do that, we can do a lot of stuff at a much faster pace. So it's an advancement in speed almost. And ultimately, this means that a lot of companies can then use this technology to enhance what they do and go faster. So you are seeing a lot of movement in the share prices of some of these companies. NVIDIA, as I mentioned, is a great example. The share price is up well over 100% this year. But I do think that this is something which is likely to change the landscape. So if we think about technology change, it does drive growth. People generally fear it when it first comes along, and you can think about anything. So this is the car replacing the horse and cart, the aeroplane replacing how we, transport ourselves around the world. And AI is another example of that. So I do think over the next decade, it's likely to create some really good new companies who become the winners over the next decade. If you look at each decade, there's been stocks that have driven the stock market. I expect it to be AI stocks. So there's probably stocks that we don't even know about today who will realize how to utilize this technology in a new way, and they will be the winners. But the great thing to highlight is that we all get exposure to this in a multi-asset fund, because a lot of these companies are in the tech space in the US. And in January this year, we went overweight tech in the US because we said, actually, there's a real opportunity here because it sold off quite a lot last year. So yeah, there is definitely lots of opportunity on that side.
Great. And in a similar vein, you're obviously busy day to day in research. And what do you see as potentially emerging investment opportunities or interesting asset classes that are really promising right now?
Yeah, so we've actually been doing quite a lot of work recently on a number of different asset classes. So firstly, if we think about China, so everybody is basically, there's so much bad news coming out of China at the moment. So as a result of that, people are avoiding that region. So is that the right or wrong thing to do? And it comes back to that emotional investing piece. So the worse the news, the more we want to look at it. So we're doing a lot of research on that because we think it actually offers quite a big opportunity. Now, we haven't gone overweight that region yet, but what we have done last year, obviously you had all the problems in the property market, and we had exposure to funds which had no exposure to China. So we were invested in Jupiter Asian Income, zero China exposure, and that was the right thing to do. So now we started to add in funds which have exposure to China. Why? Stock market is cheap, really cheap. Property market has gone through a lot of pain, but it's starting to recover. The government is starting to implement lots of stimulus into all of these areas, particularly property market, to help it recover. And it is one of the largest economies in the world. So even though a lot of people want to write it off, you can't, because it's such a big economy, such a big driver of growth. They have a lot of tech companies there too. So that's something we're looking at. The other area, which again is really unloved, is small cap. And small cap companies tend to find it very challenging to get financing from banks when interest rates rise, because the bank's thinking, will this small company survive with higher rates and the economic cycle slowing? So they're less inclined to lend them money. So that's why small caps tend to underperform as interest rates fall. But now we know that interest rates are peaking and the next move is down. So people will now start to look at these small caps and think, okay, which of these companies are good? Their financing costs will come down, then they're likely to generate better profits. So that's another area. And then lastly, just to round it off, within fixed income, we've been taking risk off the table in high yields, those higher yielding companies. They've done really well. We bought some of that last year. I've been taking that out this week, and we're adding to government bonds. So I showed you that slide showing you the opportunity there. So again, it's about trying to be that one step ahead. There's no point in me buying tech today after it's done well. So we're trying to research these opportunities using rational logic and reasoning to identify actually how should we be positioned today going forward.
Great. And then one last question. This one's from me, actually. Are Ireland going to win the Rugby World Cup?
If we get into a semi-final, I'll be happy, because obviously we've never got past the quarterfinals, and it would be great. But I think, France are pretty strong, South Africa pretty strong. It's a tough one. England, actually, 2 great games already under their belt, improving with every game. And again, they've got lots of experience at this level, so you can't write them off. But the great thing for me is I've got rugby on the TV, so I'm happy.
Good man, good man. As you say, you've got loads of information at your fingertips. Just to echo what you said earlier on, access to those details, whether it be your chart of the week or the cappuccino that I know you get out on a weekly basis with some great insight. It's all available from the team there at Marlborough. As always, today's session has been recorded, so if you want to dip into the recording, we'll make that available within the next 24, 48 hours. And if you have any colleagues who want to see that, you can obviously share that with them. Steve, my colleague in marketing, he'll be sharing details of our next webinar, which will be with QB Partners very soon. So keep an eye out for that one in your inbox and on LinkedIn. So it just leaves me to say thanks once again to you, Nathan, for today, for your input.
Thank you.
Look forward to catching up with you all again next month. Thank you very much, and goodbye.